Hey, good morning, everyone. Marty Missouri here, March 17th, 2022, Thursday, about 3 hours after the market opened this morning. Wanted to just pop in with just a very quick technical update, and we'll just focus on the U.S. equity markets once again this morning. I want to start with that NASDAQ Composite Weekly Index that I showed you, a recent study of ours, that had to do with the 50-week moving average and the 200-week moving average. And over the last roughly 30 years, almost 30 years, what has happened virtually every time actually, that the index broke through its 50-week moving average, retested it once or twice, and then failed. So we're looking for similar patterns in the price action. So again, we have that look in here where we broke through the 50-week moving average. It's rolling over, failed retest. So history says that at a minimum, we should expect to come down here and test the 200-week moving average, and you can see we're getting closer and closer to that as we speak. Had a really good day yesterday, which of course you know, and I'll talk about that more when we look at the S&P 500. So this pattern is still intact, and the price target would still be right around where that 200-day moving average rests, and that's probably another good 13-14% lower from where we are currently. If as we get there, the 200-week moving average is actually rolling over as it was here and as it was here, then we're going to have a much more ominous discussion about levels down below there. So again, this is playing itself out. The recent rally, yesterday's big rally in the NASDAQ, did absolutely nothing. In fact, you'll see when I zoom in here that it didn't even break above the downtrend line. So firmly in the downtrend line as it relates to the NASDAQ Composite. Okay, so quick look at the S&P 500. The daily chart, as you may recall, was showing us actually a bullish falling wedge pattern. And it was bullish to me because it coincided with positive divergences on the MACD and the RSI. Okay, so that's really the kind of setup you're looking for in the short term. And sure enough, we did break out above the falling wedge and above this what looked like pretty good resistance going back quite a few months. And now we're above a little bit yesterday's close. So so far so good for the bulls. Now we have some serious technical resistance just up ahead. So I'm going to show you the Fibonacci retracement lines. And what you do here, folks, is you go to the recent peak, you go to the bottom, and then typically, at least a technician would tell you that you want to look at these retracement levels. The key ones are the 38.2, the 50, and the 61.8, and those are highlighted here, green and blue. So as you can see, we're getting close to testing once again. See how we failed it here? We're about to run up against that 38.2%. Retracement plus some resistance that I lined right here. And then right above that, right about the 50, you've got a negative cross, the 50-week moving average, falling below the 200-week moving average, and the 200 resting right on that line. So suffice to say, folks, there's some real technical damage that's been done here on the daily chart, and that's a lot of repair to go. Lots of hurdles to jump before we're back up here at new all-time highs. And of course, we could speculate what that would take, resolution to the Russia-Ukraine war, the Fed changing its tune, but the Fed was pretty firm in its tune in yesterday's meeting that higher interest rates are coming, and ultimately a rolling off of the Fed's monstrous balance sheet. And I think that happens as long as the market kind of holds up. And read this morning's note for more texture on that. So then quickly we want to look here at the at our weekly chart. So the pattern on the weekly chart still is not a good look. In fact, I did something similar here with the S&P 500, and like that NASDAQ Composite, we can do a similar study here and consider the 50-week moving average. What happens when this kind of action takes place, and what to expect. And you can see, kind of like the NASDAQ, that 200-week moving average provide some support if we're in otherwise bull market conditions. We do have some pretty distinct bear flagging going on here. So we had a bear flag pattern, folks, as you recall, is where you have a declining trend and then a bottom and then counter trend consolidation for a while, meets resistance, and then what technicians do is they take the flagpole and that gives them the next price target, right? So we came almost down to that price target there, started flagging back up again. So if you did this again, we're just kind of stair-stepping our way down, ultimately to perhaps that 200-week moving average, which is an additional 22% drop, if indeed this plays itself out. Not saying it's going to, just saying that that's what the technical patterns would suggest is a growing probability at this point. And then for our long-term purposes, technically speaking, this study of the monthly movement in the S&P 500 still looks pretty compelling, and that is where we have the MACD sell signal, and that's what that is right there. You can see we circled all of these in the past when they've happened since the tech bubble bursting. It was really just this one instance where you just barely had a sell signal, where the market didn't come down, the S&P, and test the 50-month moving average. But when you come down with some momentum and you had this wide gap and you really came through and pierced the signal line, that's where you need to really pay attention to it. Now that would be a 30% decline. So folks, just in closing, remember what we're doing with these analyses is purely just playing technicians, and that is looking at price trends and then assessing what they tell us about probabilities going forward. We put more weight on the fundamentals and the macro and all that other work that we do. But we do know that a lot of people do trade the technicals, and our study of them says that absolutely, this is a process we should be going through. And as I've said earlier, it also helps us with entry and exit levels as we're rebalancing portfolios and adding positions and so forth. Sometimes we'll have a position that we want to add a certain amount to, and the technicals may not look very opportune, and therefore we may scale in much slower than we might have otherwise based on our long-term thesis. So I'll leave it there. Wanted to keep this one short. Hope you have a good rest of your day, and next up will be the weekly economic update. Take care, folks. Thanks for watching. Bye-bye.